In YouTube, the comments are always about, oh, what about the Aam Aadmi? What about the normal guy? For the normal guy, financial freedom means sacrifice. This is the plain, blunt truth.
Do you actively track your net worth?
The only number I track is how many years would my corpus last.
And how much would yours last?
If I were to retire now, the corpus would last for the next 50 years. I think there's a very naive sentiment around that the more risk you take, the more returns you get.
What are the things that one can do to actually mentally prepare themselves for a 30% or 40% market downturn or not making money in the markets for 2 years?
I don't think you can. Very, very few people can be disciplined, can avoid FOMO.
Do you consider yourself to be an ideal investor?
Oh no, not at all. I always tell myself the markets will fall after I invest. So forget it. As your income grows, people tell themselves that they deserve a better lifestyle. When they do that, they can never invest enough.
Right.
And that's the big problem. Invest, invest, invest. And I want to put this on a t-shirt. Shut up and invest.
Hello and welcome to the Net Worth Show. My name is Shagun and today we have with us a very special guest. If you've been following the show for a while, you have definitely seen him on an episode. We have with us Professor Pattu. Today, we're going to talk about his personal finance journey and how an average Indian investor can be financially free and retire early. This conversation is packed with valuable insights, so stay tuned till the end. Let's go. We'll start with thanking you for being here, coming here, and I'm really excited to finally see you in person. I don't want to start again with your story because I think you've spoken about it extensively.
Yeah.
But what I do want to talk about is when you started learning about money, did you feel like there were some mindsets or your expectations with money changed as you learned more and more about money in the markets?
So my evolution was kind of different from other people. I knew nothing about money management in my 20s. So I started only in my early 30s. And I started purely on a completely DIY. I didn't read anything. It didn't influence me too much. So I started right because people often ask me, what are your biggest mistakes?
Yeah.
I've not made any big mistakes and money mistakes. I don't have, at least not the ones I regret.
Yeah.
Minor mistakes here and there, that's fine. But what has changed is the way I thought people think about money. Other people think about money. Because when I started Freefincal, I knew nothing about behavioral finance. Absolutely nothing. I assumed that logic would appeal to everybody. People would be regular investors. They wouldn't make mistakes based on FOMO and so on. That has been a big change. The revelation that very, very few people can be disciplined, can avoid FOMO, and really be patient with respect to the capital markets and so on. So those are the biggest lessons I would say that has changed over time.
So I would want to talk about how to become an ideal investor later on. But before that, let's talk about your personal finance so far. How do you actively track your net worth?
I track, the only number I track is how many years would my corpus last.
And how much would yours last?
I would say if I were to retire now, I'm 51, so if I were to retire now, the corpus would last more than for the next 50 years, more than 50 years.
So you have money for the next 50 years of your life?
Yes, my corpus will outlive me, so that's the goal.
Right. And when you started, your finance journey, was that the goal? Did you want this 50x, or was it just, adding to your corpus and you just want to accumulate wealth?
So I never had any targets. I just wanted a comfortable retirement because I was scared about retirement. I was very emotional about retirement because I started my journey in debt, which I've talked about earlier.
Right.
I became very emotional, just like people are emotional about, buying a house and so on, and then closing out a loan. I was very emotional about retirement.
Yeah.
And because of that, I just said, I need to keep investing enough for a financially independent retirement. And like everybody else, when I did my first retirement calculation, the amount I needed to invest was way higher than what I could afford, way higher. But that's the point. That's how everybody's journey starts.
Right.
And that's where you need to be patient and keep investing regularly. A little bit of luck from the markets, a little bit of luck from in your career side, and you get promotions, etc.
Right.
Then things will set into place maybe 5-6 years later. So that's how I started. And I never had any particular goals. Even this financially independent thing, this fire business that people talk, I got annoyed that every Tom, Dick and Harry was talking about it. And I thought, okay, let me go check my net worth and see where I stand. And I realized that I had fired a long time ago. I never checked, right?
That must have been a good day, no?
Yeah, it was not a bad day at all. Yeah, not a bad day at all. But that's the point. I never set myself these kind of goals.
Yeah.
But because I write and because a lot of people ask me these things, I have to give them some targets.
Yeah.
And that's where this kind of withdrawal rates and multiples of corpus, 30x, 40x kind of thing started.
And how often do you rebalance and review your portfolios?
I seriously review once a year.
Okay.
Of course, when I invest, I have to look at my goal sheets. Therefore, I do look at my asset allocation, but I don't act on it.
Okay.
I act on it once a year, and I do rebalance if the deviation is more than 5%. If it's 5% away off, then I rebalance. I don't worry about taxes, nothing. I just do a hard rebalance.
Yeah. And when you said that every Tom, Dick and Harry is talking about financial freedom, and you've been speaking about this and writing about this for a long time, before FIRE was a concept. So now when you observe the Indian investor today, do you think that they're chasing the right version of financial freedom, or do they have misconceptions about what that life could be?
Oh, I think there are a lot of misconceptions. I think many people are actually frustrated with their jobs.
Yeah.
That's why they want FIRE.
Yeah.
And of course, the usual misconceptions of assuming that too much equity would work after retirement, right? They can easily beat inflation. So the last 2 years has been a big lesson for many people in markets. I'm very happy about it. Somebody said I shouldn't wish evil, think about a poor market and so on.
Yeah.
But I think it's a chastening experience for many people, especially those who entered into the market after COVID or during the lockdown. Right, that's when the demat accounts boomed, the capital market participation boomed.
Right.
But those guys are understanding that equity returns are not going to be good every year. There's going to be periods of flat markets, regardless of the reasons. We waste a lot of time on social media worrying about what is the reason. That doesn't matter. History tells us there will always be periods of flat markets.
Yeah.
And this teaches us about risk. And I think many people should ask themselves, if they retire today, and if they're going to face this kind of prolonged sideways market that we face now for the next 2 years, 3 years, for some reason, I don't know, can their portfolio handle it? Or can they emotionally handle it?
Yeah.
So this is a nice wake-up call to understand their own risks. So, and eradicate some of the misconceptions about FIRE. So I think it's not an easy thing.
Yeah.
It looks good in a bull market. Everybody is happy in a bull market. They think that they can achieve. I know a lot of people who have become crorepatis in the last bull market. That is after COVID, the bull run after COVID. But then they now realize it's not going to be smooth ride all the time. There will be ups and downs. So that's it.
When you said that you've understood how important behavioral aspect is in finance, and especially here when you see a bad market, what are the things that one can do to actually mentally prepare themselves for a 30% or 40% market downturn, or not making money in the markets for 2 years? How do you prepare yourself for that?
I don't think you can. It's a very hard thing. I think you have to live through it. Of course, you can learn about risk. You can look at past risk. But there are two things in the market that I see.
Okay.
One is the time risk and one is the return risk. The return, there's something called volatility bunching in the markets, where if you look at past volatility, upward volatility, that is huge uptick in the markets, that is usually followed by a sudden drop. And a sudden crash is usually followed closely by a sudden uptick again. So that's the positive returns and the negative returns. Large positive returns and large negative returns, they kind of occur close to each other.
Okay.
So that kind of thing you can kind of manage. The biggest problem is time. If your money is underwater for several years, can you handle it? That is where the markets will really test your patience. Right? Already 1 year, 2 years, people are always saying SIPs are bad. People who thought about sold SIPs are bad. You can't do. Then there are now statements that retail investors should not be in the market. And there should be a crash to save the currency. And all sorts of weird notions are out there. I find it bizarre.
Yeah.
Right? But the way I see it, nothing new has happened.
Yeah.
If you look in terms of market risk, nothing. There's always some reason behind it. But you should get used to this downturn and the fact that you can go several years without making money. That period that you should invest more and more and more.
Okay.
I think those who are in the capital market should appreciate that the best time to make money is when an asset is not doing well,
Okay.
when nobody is talking good about the asset.
Hmm.
For example, last year this time,
Hmm.
gold, 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 gold. Everybody was after gold.
Hmm.
And now it's international equity. Why? Because it's shining, right? If it's shining, then the opportunity is already lost.
Yeah.
Because if you're going to follow the crowd and invest there and expect the past return to be reproduced,
Hmm.
you're not going to get it. The law of averages never fails.
Yeah.
So you should invest in assets which nobody's talking about.
Hmm.
Invest in, I'm all for investing in international equity. I'm all for investing in gold. It's all fine. Diversification is all fine. But do it because you want your portfolio volatility to be contained.
Okay.
If you know what I mean.
Hmm.
Nobody looks at the portfolio volatility at that level. They're always saying, I invested in this fund, I invested in this stock, I invested in international equity, gold. And they're talking about piecemeal returns here and there.
Right.
What I'm saying, take a bird's eye view and look at how your portfolio is fluctuating over time.
Hmm.
Is that contained with diversification?
Okay.
That's the only goal of diversification.
Hmm.
Not everything will shine at all times, and it should not.
Yeah. A lot of investors think that when you want to participate in the markets, you set your SIP and then that's it. At least for the long-term horizon. Do you think there is something that's missing in this approach?
I don't think you should set it and forget about it. In fact, I think there are a lot to be done before you even set it.
Okay.
Right? In a bull market, everybody wants to set and forget.
Hmm.
But now you know that it doesn't work the way you want.
Hmm.
So I think people should understand risks.
Okay.
Especially in the capital markets, the kind of risks that what do I expect? Whether it's an equity fund or a debt fund or anything else, they should understand risks before investing. And they should ask, is it the right choice for my goal? So that's where goal planning is important. Setting goals is the first thing, and only then they should preferably start investing. See, in my case, I was able to cut down the mistakes because I never chose products for the sake of choosing products. I never chose something just to save tax because I already had my NPS that was helping me save. So I never bought anything else in advance. But even if I did, that was tagged to a goal. So you must always tag your investments to the goal and ask yourself, am I taking the right amount of risk for that goal?
Yeah.
Too less or too much is the problem. So that kind of goal-oriented process is missing in many.
Yeah, and you emphasize a lot on risk. How does a person figure out or evaluate what their risk capacity is?
I think they should understand how much returns fluctuate.
Okay.
I think there's a very naive sentiment around that the more risk you take, the more returns you get. That is true in a very simplistic manner because compared to a fixed deposit or compared to an SB account, buying a debt fund or buying an equity fund gives you the probability of getting a higher return.
Yeah.
But it's not going to be all the time. Right? There will be a spread because more the risk, what happens is the spread in returns becomes higher. Okay. So the gap between the lowest possible return and the highest possible return keeps widening.
Yeah.
So that's what happens when you increase the risk. And if you don't understand this gap, then you are going to be in trouble. Like many people are. When they experience a bear market or a crash for the first time, they just ask, oh, can this also happen? Yes, it has happened several times in the past. So we need to study the past. Although there are past performance disclaimers, that only applies to returns. Yeah. It does not apply to risk. You should look at the past to understand the risk. And you should tell yourself the worst risk that happened in the past can repeat itself. Of course, risk can happen. New risks can also come in. But at least that much you should be prepared for.
Right. Okay. And what about goal setting? I mean, it's important to have some sort of finish line, I'm sure. But as you're nearing your goal, let's say a person is in their late 30s and their dream is to retire sometime in their late 40s. Now that they have 10 years to their final goal, what are the steps now? What does the roadmap look like?
So there are two things here. One is they should get their asset allocation right.
Okay.
And they should tell themselves or ask themselves, how much equity am I going to hold after retirement?
Okay.
Because usually people typically tend to hold 40 to 60% equity. But it will vary. before retirement.
Yeah.
But after retirement, I would recommend anything for not more than 40%.
Okay.
So it's actually a nice switch. You can hold 60-40, 60% equity, 40% fixed income before retirement,
Okay.
and just flip it 60% fixed income and 40% equity after retirement. That's a nice kind of thumb rule to
Yeah.
understand. So they must get ready for this and gradually start lowering the equity allocation in the last decade of retirement. And they should ask themselves, what am I going to do with my time? Because ideally, they should have some form of gainful employment after retirement as well. Not a regular job, but occasionally freelancing, consulting, that kind of thing, because that will keep them healthy, keep them active and all that. And that will also help them beat inflation to a small extent after retirement.
Okay. And in the Indian context, there are certain things that I think the Western concept of financial freedom might not cover. Aging parents, dependents, your kids.
Right.
In India, it's not even, the 18 age limit. You support your kids throughout their lives. So when a person is building their retirement corpus or the financial freedom corpus, how should they look at all of these nuances and then create a more holistic corpus?
Yeah, so it is a problem, but I think it's a problem everywhere.
Yeah.
The point is that you should look at retirement as a continuation of a lifestyle.
Okay.
Today, what is my lifestyle today? And when you start doing retirement planning, the primary goal of retirement planning is to maintain your current lifestyle.
Yeah.
That's your minimum.
Right.
So in my lifestyle, I should ask myself, what are the expenses that will continue in retirement? Yes, I have aging parents today.
Yeah.
I spend a lot of money taking care of them. But that may not be the case after retirement. They may not be around. And children may be independent after when I retire.
Yeah.
But where it will hurt you is the amount you can invest. The actual calculation of the expenses that you need for retirement and the retirement corpus necessary, that is not going to change much because of these factors, because of the family. But the amount you can actually invest today, that plays a huge role. Because if your parents, they're sick and you're paying a lot of money every month to take care of them, and you need to, tutor your children, there are additional expenses besides school, I mean.
Yeah.
So you cannot invest. And then there, on top of that, people will have a home loan running, they'll have a car loan running, and that's the problem. And so that's why I would say, think before you do this. Think before you take on debt.
Yeah.
The retirement planning, nobody factors in before they buy any kind of thing for themselves on loan.
Right.
Let's say, I'll take care of baad mein tek jayenge. That's the kind of thing. Forget about it. It's not today. What I can't see today is not a problem for me today.
Yeah.
That is the big problem. It's not on your horizon today, but it's there. It's going to come for sure. And therefore, you need to be prepared for it. So the way to do it is to keep your lifestyle in check, to take care of it, very consciously reduce your expenses, your wants. Your needs you can't do anything about, but your wants, because as your income grows, people tell themselves that they deserve a better lifestyle, and they start spending more and more and more. When they do that, they can never invest enough.
Right.
And that's the big problem.
Yeah. So do you think that being frugal is what will preserve your retirement corpus? Do you agree with that statement?
If you tell me, I'll give you 10 lakhs, go spend whatever you want, I won't spend, because I would say I don't need it, because I'm frugal by mindset. It's a mindset thing. So I would rather you tell me, give me the money, I'll invest. But you can't teach frugality to people. However, it is very clear that the frugal people tend to invest more. So which means that the non-frugal people, the other guys, they must keep the lifestyle in check.
Yeah.
Because if you ask me, what should I do to achieve financial independence, financial freedom? I'm a normal guy, because in YouTube, the comments are always about, oh, what about the Aam Aadmi? What about the normal guy? Well, for the normal guy, financial freedom means sacrifice. This is the plain, blunt truth.
Right.
You cannot say, I will buy whatever I want, I will splurge on whatever I want, I will invest after all that, and say, I will still want to be financially independent. Forget about early retirement. Normal retirement is 55 today, 55, let's say. Even that is not possible if you don't have some element of sacrifice in your life. So it's not frugality, but you should consciously keep your lifestyle in check.
Right.
So that's the problem.
How do you differentiate between a good debt that is good for you in sense of maybe it adds to your assets versus a bad debt that you know is going to end up being a really big trap? Do you have a framework for that?
See, I think I read in a book, I think it's called The Millionaire Mindset. I'm not sure. I think the author said, if you think about buying something, then you can't afford it.
Okay.
So if you can really afford something, you should be able to buy it without thinking. That's the definition of affordability. If you're thinking about something, is it good? Should I buy this model? Shall I buy this price? Then that means you can't afford it.
Yeah.
That's really hit me hard. So when it comes to debt, of course, there are some things that people need to buy.
Yes.
So-called bad debt, where the value of the asset that you buy depreciates.
Yeah.
So sometimes you need a PC for your college. You need a bike for your transport. You need it. Otherwise, it's going to be a lot of health problems with your health and so on.
Yeah.
So then it's okay. Don't beat yourself too much about it. But don't do it because of a want, except for a house. See, the problem with a house is not buying it on loan. Buying it on loan is perfectly fine. But the problem is that people rush to prepay. So no. In the age of AI, the comment I get is, in the age of AI, no jobs are secure, so you should prepay your loan. I usually tell people, look, you open an investment. Say that's your home loan prepayment fund or whatever you want to call it. Put all your prepayment extra money into that fund. Let it grow.
Yeah.
Anytime you lose your job, redeem it or close the loan. Or close whatever amount of loan you can. So that you're safe there. But keep doing the EMI thing. You pay the EMIs and you take extra money, you get bonuses, whatever, push it into this fund. If you lose your job, you're going to prepay. So it's always there.
Right.
If you don't lose your job, you have the employment, you have the salary checks coming in, you have the EMI running. Let that EMI run. You invest on the side for your goals. And if you did not rush to prepay, there is a very good chance that this fund and your other investments will beat the home loan return over a period of 10 years, 15 years. So you have everything now. So you have this fund which will, so you have taken the behavioral part of it, the psychological part of it. You don't have this fear of, you have the money, you're going to redeem and push it in.
Yeah.
So why don't you do that? Why do you want to rush to prepay? The biggest problem in home loan is people say, oh, I am paying so much interest to the bank.
Yeah.
Economics or finance 101. When I pay interest over time, you should never add the total interest. It's completely wrong, because there's time value of money.
Okay.
Right? Nobody understands time value of money. People say, oh, no, your house only costs that much. You're paying more than twice that in interest, but you're paying it over 15 years.
Yeah.
It's not the same. Right? So don't be in a hurry to prepay. So buy a house, that's fine. But don't be in a hurry to prepay. But when you buy the house, make sure your EMIs are not more than 30% of your take home.
Okay.
If you can afford it. 30% of your total take home. That is, if two people are working, total take home. If you can manage, maybe 35%. If you can manage that, you can continue investing for retirement when the home loan is being serviced.
Yeah.
And then additional money you get here and there, you can put it in that closure fund I just talked about. That's fine. So it's set up that way. And you just leave the EMI running. Because in India, people buy 15-year home loans. Most of them pre-close by 8 to 10 years.
Right.
But there are very few people who have let it run for 15 years.
But I think that's also because that has a lot of emotional and mental, backing. People just want to get rid of loan.
Exactly. What can I say? The biggest negative of all that is retirement plan. First, you buy a huge house, much more than you should. The EMI is very high. And then you spend the next 8 years doing everything to pre-close. So for nearly a decade, you've put off retirement plan.
Yeah.
For most people. And then there's a problem that some people buy a second home in their 40s, which is bizarre. So retirement planning is the last priority for many people, which is very sad. It should be the other way around.
Yeah, it is. And for retirement planning, how should one figure out, like for you, it's 50x, right? But for like you said, an Aam Aadmi investor, what should be their framework to calculate what the retirement corpus should be?
There are two ways to do it.
Hmm.
One is slightly mathy way, but not too mathy. So you assume that your expenses will double every 10 years.
Okay.
That corresponds to about a 7% inflation.
Hmm.
So you take your annual expenses today, remove expenses for your children, remove expenses for your parents, in-laws, etc. Just the essential expenses for you and your spouse, annual expenses. And depending on your retirement age, you assume that your money doubles every 10 years. So you
Okay.
can quickly estimate what will be your annual expenses at the time of retirement.
Yeah.
AI will do it for you.
Yeah.
Multiply that by at least 33x. That corresponds to a withdrawal rate of about 3.5%. That is withdrawal rate meaning annual expenses at the time of retirement divided by the corpus.
Okay.
So that's withdrawal rate. And if you do that, that should be enough. So multiply the annual expenses at retirement by 33 times.
Okay.
That should be a minimum corpus that you need. That's one way to do it. It can be done a couple of minutes. The other way to do it is don't worry about all that. Look at your essential expenses today and ask yourself if you can invest 50% of those essential expenses towards retirement today. And that investment includes your employer contributions, etc. for EPF, NPS, whatever it is, including all your employer contributions, mandatory deductions from your take home, whatever you can invest, add them together. That should be minimum 50%.
Okay.
If you can do that, you should be reasonably on track. And you should also strive to increase your investments as much as possible. Preferably 10%, at least 5%.
Okay. And when we're having all of these conversations, we often assume that the person who's planning for the retirement is in their 30s. But the reality is that concept as a fire came when a lot of people are in their late 40s as well, right? So now for those people who perhaps did not plan their finances very well in the early stages of their career, what should they be doing now to, do a little bit of damage control?
Yeah, so let's assume somebody is 45
Yeah.
and not thought about finance at all due to some personal constraints and so on. I would say don't worry too much about retirement calculation because that's going to really freak you out. You're going to lose sleep.
Yeah.
I would say first take care of your health. Whatever remaining health you have, I would say for most people, considering the way they they work hard, eat and party and so on, whatever remaining health, first preserve that.
Yeah.
Ensure it for the remainder of your life. Tell yourself that you need to reduce your lifestyle.
Okay.
And you may need to extend your retirement beyond 55 or whatever it is. You may need to do it. And therefore, you need to have a second career.
Yeah.
So focus on that and invest as much as possible. Invest as much as possible is a mantra that's independent of age.
Yeah.
But for an older guy, these additional nuances are important.
Okay. And do you consider yourself to be an ideal investor?
Oh, no, not at all. I'm not an ideal investor. My superpower is discipline. That is my biggest strength.
Do you think discipline alone is enough to experience the magic of compounding? Or are there more?
I would say discipline is essential, but you also need good diversification. My portfolio is not very well diversified.
Okay.
Right? I mean, ideally speaking, I don't have any gold in it. I have very little international equity in my retirement portfolio. So I'm not big on diversification because diversification also implies more work for you. If you add in more and more asset class, then you have to worry about balancing, rebalancing, and most people don't do that. They just let it grow like an untended garden. I don't want to do that. I want to keep things simple. So from that point of view, I would say I'm not an ideal investor in terms of having some kind of portfolio growth every year or reducing lower volatility due to diversification. I am not worried too much about that. I am more of a guy who tries to invest as much as possible and invest like a machine.
So from your experience, and since I'm sure you speak about this day in and day out, what are some things that people can do to become the closest version of an ideal investor?
I think I would say don't chase after becoming an ideal investor. It's not worth that. But I would say first of all, don't make any decisions based on FOMO.
Hmm.
You should ask yourself why. For example, I used to get tons of email last year about gold. Can I invest in gold? Can I invest in... the only response I have is, why are you asking me this? Or you should ask yourself, why do you want to invest in gold? Now, why do you want to invest in international equity now? Only because it's doing well. Every asset class will have its ups and downs. So if you invest in gold, you must be ready to go through its bear phase. It will go through its bear phase. The problem with a bull market is, and problem with a bubble is, when people talk about an asset class, like it will never come back. There are people who went on television and told the audience that gold will never fall in the height of last year's bull run. But that has changed. But that's not true. If you look at your history, that's where history matters. You look at your history, gold has gone through phases where it has been underwater. I'm talking about gold in INR. Forget the gold USD. Gold USD is even more horrible. Gold in INR has been underwater for several years in patches. So are you ready for that? Will you continue to hold the faith in gold when that happens? People will say yes today because they know they get the returns.
But when it happens,
they never do that. That's the problem. And that's why I'm scared of taking on too many asset classes, because it causes too much problems. I mean, again, it's giving me fodder to get confused. It's fodder for confusion. That's how I look. I want to keep it minimal, and I'm getting old. I don't want to chase after these things.
And how should investors differentiate between market noise and news that they should be paying attention to?
Yeah, so I think you should get yourself a new hobby. Most people should get themselves a different hobby. Once you set your money management in place, once you listed your goals, once you've taken care of your emergency fund, health insurance, life insurance, and once you've decided for this goal, that's my asset allocation. And for this asset allocation, I'm going to invest in these products. Once that is in place, you've done it, either on your own or with professional help. Once you do it, the less you know about the market, the better off you are. Because the markets are going to go up and go down. And I'm assuming, I'm talking about a young guy whose goals are several years away. So they don't need to look at it once a year. Look at your portfolio once a year. And you say in your 20s, you don't even need to look at it once a year. The lesser you look at it, the better off it is. Just focus on pushing money into the funds. So instead of looking at the portfolio, I would look at how much I invested every month. So I invested 10,000 rupees last month. Can I make it 10,100 this month? So this is why I'm not a big fan of running SIPs. Because what people do is people run, oh, I have started a 5,000 SIP. I'm done. My job is done. No, your job is not done. I say, look, instead of doing the 5,000 SIP, invest manually. A boomer uncle like me can invest in under a minute. Online on my PC or mobile. So you can do it faster. You can't spare 1 minute for your portfolio a month. Right? So if you invest 5,000, push yourself to invest 5,100 next month. 5,200 2 months later. Whatever. If you push yourself like that, then you're going to invest more and more and more. That is where the wealth is built. Because every time people ask me about my portfolio, there is a very naive question somewhere. Is it, how much did you invest? And how much were your gains? Right? People assume that the gains will be so much higher than the actual
invested amount.
That's not going to be true. It will, in my case, it's probably about twice. For every 100 rupees I invested, the gain is close to 200. But that is not something I've always consciously tracked or worried about. I've always worried about if I can make that 100, 110. So focus on your investment blog, in your investment diary. How much do you invest each month?
And if somebody watches this conversation and takes away one lesson, what would you want that to be?
I would say just invest. Invest. Put your head down and invest. And I want to put this on a t-shirt. Shut up and invest. I want to put that on a t-shirt. I mean, it may sound arrogant, but I think you should just put your head down and invest.
I think far too many people are paralyzed, before they invest. For whatever, I mean, they make up 10 scenarios before they actually get in the markets. So I think maybe we need the t-shirt.
No, I think the one mantra that has helped me is the markets will fall after I invest. I always tell myself, after I invest, it will fall. It will always going to fall. So forget it. You just invest when you have money. Don't wait for the right time. Don't say, I'm going to stop my SIPs when there is an all-time high, when the market is falling. Don't. Just keep investing.
Yeah.
Because I think those who come out and go into the market tactically, or the guy who keeps investing continuously, both persons are timing the market in a way.
Okay.
Because both people are waiting for the opportunity where the bull run starts and it's gonna change their lives.
Yeah.
Right. So the best way to time the market or wait for the right time to invest is in the market. If you are in the market, you are sure not to miss the bull run.
Right.
So just do it.
Yeah.
And focus on your income.
Focus on income. Thank you so much, sir, for coming here and giving us your time. A very fun
My
conversation, and I'm glad that we came here and finally met. And thank you so much. I really hope the audience loves it too.
Yeah. Thank you.
And you too. I hope you like this conversation. Now, I will see you in the next episode of the Net Worth Show. So take care until then.